Well, good morning, everybody, and welcome to today's webinar. Today, what I'm going to talk about is a high probability trades using weekly option credit spreads. Last week with Investors Inspiration, we talked about using credit spreads for a little bit longer time period. And the time period there was looking for something that has an expiration of about 30 to 40 days out. Today we're looking at shorter term. We're looking at the SPX or the weekly options, and I'll tell you why I chose the SPX later on. But as I'm going through today's presentation, please, if you have any questions, I got the question box up right in front of me. I can see your question. I will answer that immediately, so you're not sitting there wondering, what's going on. So please ask your questions whenever you feel that you're a little bit lost. Okay. A couple goals for today's webinar. I want to take an honest look at why most traders lose. And how to flip the script, okay? And if you look at it, it's people don't understand market manipulation. Of course, they don't get in when they should get in, and they don't get out when they should get out. There's a couple other reasons. One is that they have poor money management, and the other is that they've got their ego involved in it, and they don't take losses when losses present themselves. Losses is part of this game. You have to learn to embrace that, and that's one of the main things that Dr. Van Tharp taught me, and that's one of the reasons why I became such a success. My training was in mechanical engineering, and in the world of mechanical engineering, you had the laws of physics and you had equations where you could calculate an exact answer. You can't do that on the stock market. And yeah, I tried to, apply that discipline to the stock market. And when, I did my analysis and I would put my trade in, and the market would go the opposite direction, and how dare it? How dare it go the opposite direction? And a lot of times I would throw good money after bad. And really to be a successful trader, you have to have a rock solid strategy, which I have too. And you have to accept losses. Losses is part of the game. You have to cut your losses short, but you're going to have losers. You're going to have losing strings. So you want to just stay with your strategy, work with it, paper trade it for a while, make sure you fully understand it, and then your job is just to execute it. And hours and hours of training, and you can become a success. The stock market is not an easy arena for you to make money. There are a lot of other arenas that are easier. Stock market is a great challenge, and I think that's what brings a lot of people into the stock market. But then when they see that they're having losers and it's not working out right, and they throw up their hands and they say, well, it's all rigged, and there's no way I can make money here. Well, you can make nice money if you have realistic goals and you have a strategy and you stick with the strategy. You follow the rules, you don't allow your ego to enter it, and you have good entry and exit techniques. Also, I want to basically teach you a high probability short-term income generating trading technique. Now, this technique we're going to be talking about today is really, really nice because some of you might not have big portfolios, and you might only have a small amount, and with trading the weeklies, they are inexpensive. You can get in and out for relatively, I don't want to use the word cheap, but they are inexpensive. So it's good for small starter accounts, but you can also use this as part of your strategy with a larger account. We're also going to talk about how to apply these techniques while leveraging with the weekly options, specifically the SPX, And Michael comes in and he says, you must plan your trade and trade your plan. That's good business sense. I mean, you need to treat this as a business, and you definitely have to have a plan. A good business plan has got to have pitfalls and what your rules are and how you're going to do it and how you're going to handle anything. So Michael, that's an excellent add to some of the things I'm saying here. You must plan your trade and trade your plan. Very good, very good. Okay, Renee mentioned that I've been doing this for a long time, and I'm right now, my passion really is teaching. I've made my living at this thing for a long time, and at this point in time, I really get a kick out of working with people to help them to also become a success. And I get a big kick out of when I see some of my mentees really get it and really start trading well. I'm a hedge fund manager. I'm a keynote speaker. I do this for a living. I've written 3 financial books, but I'm currently the founder and head trader at optionsinfinity.com, and I'm going to take you to the website towards the end and offer you a free membership. And again, the website is www.optionsinfinity.com. And there's two strategies two programs that I have here, and both those programs, I've got a 4-part video that explains what I do. We've got real-time text and email alerts. It's every night I put on basically a nightly blog on what we're doing and how we're managing the trades. And like I said, once a month we get together and we talk. I lead the discussion, but it's open for questions to all the mentees. And this is really where I'm focusing my time now. I still trade. I'm still an active trader, and everything I teach is what I use. It's not I'm teaching something that's and then I go away from it. I use it every day. So let's just jump right in. This is a trade example, and this was on the SPX. So this is SPX. This is a 10-day, 15-minute chart that's been blown up, and I'm only showing about 4 or 5 days here. These mysterious lines are the regression channel. The purple line here is called the regression line, and it is calculated by taking 50% of the price above and 50% of the price below. So it's actually an excellent trend line. Now the mathematicians get in there, and this green line is the plus or minus 1 standard deviation. 1 standard deviation says that the price will be contained within 1 standard deviation about 67-68% of the time. And the gold line, the +2 and the -2 standard deviation, the prices will be contained within that 95% of the time. Now, you're going to occasionally get an outlier, But if you look upon this thing as a big old magnet, the further out you give, the harder it wants to pull, it back. And a lot of times it'll overshoot and go back up and then come back. One of the beauties and why I focus solely on the SPX, one of the reasons, I'll go into some more later, is that it follows this regression line very closely, very closely. The premiums that the market makers put on the options are based on about a 1% deviation from this. It doesn't deviate very much. You can see that here's an excursion down to the -2, here's an excursion up to the +1, and a lot of times it'll come right back here to this point here. The other thing I use is when to get out. I mean, we talked about poor entry and poor exit as being some of the big reasons, and very few people talk about the exit. I believe the exit is as important, if not more important, than when you get in, because you don't want to, you know, the old adage is you know, you want to cut your losses short but let your profits run. Well, what does that mean? What does that mean? How do I know when my profits should be taken? That's when I use the Fibonacci's. The Fibonacci's, when it comes up to a certain level, I know that the move is overextended based on math. Okay, so these are really the two things that I focus on: the regression channel and the Fibonacci's. And Bill says the regression line, is it the same as the bell curve? Well, let me show you. Let me show you. That's a good observation. There's the standard bell curve for you statisticians out there. Here's the standard bell curve. This is the regression line. This is the regression line. This is minus and plus 1 standard deviation. And notice that all the data, and in this case, we're talking about price of the SPX. The price, 68.2% of all prices will be contained within the ±1 standard deviation. Okay. Then when you go to the ±2 standard deviations, you're adding another 27.2% on that, and you're pushing 95% of all the prices will be contained within those lines. Well, if you know that, doesn't it make sense that when it's down around here, that's the time for you to be bullish? When everybody else is bearish, that's the time when you want to be bullish. And that's why the standard deviation, the regression channel, is so accurate. You don't want to just jump in and say, hey, well, the market's been going down. I think a correction's due. Well, these regression channels tell you, yeah, this is the time. Now, there are going to be times when you have an outlier, and it's going to come down below here, and that's okay. That I start really licking my chops when we get something like that, but I'll always wait till I get a measured move before I get into the position. Now, later on when we go to the website, I'm gonna, I've been talking about regression channel, I've been talking about Fibonacci's, I've been talking about a measured move. All this I teach on my website for free. I've got little webinars on each one of those for free. All you have to do is put in your email and you become a free member, and you have access to all that information. All right. So now this particular one, I always get in with a vertical spread. In this particular one, I did an at the money, pretty much, an at the money 5-point spread where I sold the 2045 and bought the 2040 for protection. And that's a bull put. I captured $2.50 worth of credit. And when it came up to right here, I knew it was time to get out. And I looked over there and I said, well, I can get out, but I have to buy it back for 40 cents. That's an 80% return in 2 days. It's an 80%, well, I'm sorry, 85% return in 2 days. Do I ever use the SPY? Not for credit spreads, because the SPY is the E.T.F of the SPX, and it is 1/100th of the size of the SPX. Therefore, the credit is less. So it makes sense to go with the big boy that is valued at $2,000, because you get nice credit, and that's what it's all about. I need to get some nice credit here. Okay, good questions that are coming in. Okay, we did the standard deviation. Let me just spend a minute and talk about Dr. Van Tharp. He's written a book, and it's worth going to Amazon and picking up his book, Trade Your Way to Financial Freedom. It's relatively inexpensive. Dr. Van Tharp is, I give him a lot of credit for my success. But in his book, he talks about, financial freedom is really a new way to think about your money. Most people think you win the money game by having the most money and the most toys. Well, this goes back to, what is your goal? Why are you in the market? What is your plan? Okay, trade your plan. If you don't know why you're in the market, if you're just trying to win the money game by having a lot of money and more toys, that ain't gonna work. That ain't gonna work. Okay? Financial freedom means that your money is working for you. It can effectively replace your need to work a 9-to-5 job. Well, don't quit your day job just yet. It's gonna take a lot of time and a lot of money. To do that, you have to go through losing streaks. You have to spend the hours to really understand that. That doesn't mean you won't spend hundreds or even thousands of hours building the foundation. There's a good book out there called The Outliers, okay, and they talk about just that. But financial freedom is possible once you laid the right foundation. Going back to this plan, going back to the plan, how much do you need to earn to replace your income? That's an awesome goal. That's an awesome goal. Now you can start putting together the rest of your plan, and then financial freedom is possible. But don't forget, you got to put the time in. It's not going to just jump out at you. Okay, this is good. Lou just came in with a statement. He says, I've been trading options since 1999. In the past 7 years, started using weekly credit vertical options spreads, puts and calls. Can affirm that commissions and fees can kill you. All right. And that's why you want to trade the big boys. You want to trade the SPX. You don't want to trade the QQQs. You don't want to trade the SPY on credit spreads. Credit spreads is the name of the game. That's the name of the game. Getting good credit requires you to trade the big boys. So those are the nuances. All right. Good discussions there. Are weeklies your best path? Well, let's take a look at it. Let's take a look at the futures market. And I can talk from experience because I've dabbled in all these. Futures, you can get quick profits because of the large leverage, but 99% of all retail accounts, that's you and me, not only lose money, but a lot lose their whole account trading futures and Forex. Personal experience. I was trading futures, and I was trading them successfully for a little bit more than 2 years. And I thought I had it. I had it. I was making a lot of money trading futures. Very exciting. In and out, in and out. And I thought I really had it. Okay. And in one day, 4 hours to be exact, I lost half of what I had gained in 2 years. And I said to myself, this is not the game for me. This is not the game for me. And I got out. And I was part of the 99%. I didn't lose all of it. I was fortunate enough to not overextend myself. But I know exactly what they're talking about here. Stocks. How about trading stocks? Well, I trade stocks. Most of my portfolio is in stocks. Stocks are good for extremely large accounts. Extremely large accounts. I have somebody coming in saying my audio has gone. Tracy, I don't know what to say about that. It doesn't appear like anybody else is having that problem at this point in time. You might want to go out and come back in. But stocks are great for large accounts when you're finding compounding wealth at a very small percent each year. Over the long run, the market gains about 9% a year, and that's a fact. But there are down draws on stocks that you have to be careful of. And Fred came in and said, do you have any stops? Absolutely not. I have gotten stopped out and watched it come in the other direction so many times, Fred, that I do not use stops at all. I use visual stops. I know when the market goes against me on a measured move, I get out and take a loss. I also know when it goes to the Fibonacci's, it's time to get out and take my profit. And I'll put in lines. I use Thinkorswim. I'm not affiliated with them, but I think their trading platform's an excellent one. I'll actually put in lines, and they will alert me when it gets close to one of those, visual stops, if you will. I don't put in hard stops. Okay. You can sell monthly options, and that's good. That's good. And part of my program, Options Pro, is selling monthly options. It's good for all size accounts, but your target is a little bit less per year. Weekly options is good for small and large accounts looking to make sizable, consistent income. Okay, another question came in. How would trading options on the E-mini compare to options on the SPX? Just look at the amount. Look at how much the E-mini costs. Hold on for a second. Well, okay, the E-mini is valued at 2,554 right now, where the SPX is exactly the same. Okay. The only problem with the E-mini is one, it's a future. So I haven't even looked to see if there are options available on that. Let me just take a quick peek and see if I can get an option on an E-mini. Yeah, I can. Okay. So to answer your question, and that's good. That's good. I never realized that, but that would be an okay thing to do, Ellis. No problem. Okay, somebody came in and said, I agree with no stops. Don't you think Okay. Ever trade a butterfly? Nope. I have. I know what a butterfly is. I know how to put it on. My trading keeps the number of stocks that I look at to 3 Amazon, Google, and Priceline, and the number of indices that I look at, the RUT and SPX, and that's my portfolio. That's my portfolio. Those are the big boys. That's what I focus in on for selling monthly options. For selling the weekly options, I focus right in on the SPX. I think you got to keep things simple. You got to keep the market basket small so you know exactly what you're looking at, and you need to keep your trading simple. And that's why I've found the two things, the regression channel and the Fibonacci's, to be excellent tools. Yes, Gary came in and he said future options are not available in IRA and Roth accounts, and that might, but if you don't have that, you can you can easily trade the E-mini. That's good. Okay, that's good. Okay, good. Let me just talk a little bit more about weekly options. You got to be careful because remember, options, there's two ways they determine the premium. One is the intrinsic value, the other is the extrinsic value. If you're at the money or in the money, you'll have both those components. One is time, and the other is the premium based on the length of the amount away from the selling price it is. For out of the money, you only have time value. Okay, and weekly options are rigged with explosive gamma and very high premiums. This is by design. The market makers pocket this money and take it right out of your account during times of rapid price movement. What I'm going to show you is what you need to do is join the market makers by selling options on the indices, especially the SPX. We want to sell. We're a seller. But we never want to sell naked. We'll always have protection, and that's why I use credit spreads. You say, well, if you sell naked, you can pick up the lion's share of the credit. I mean, if I put on a credit spread, I might have $2.50 worth of credit. If I sell one of the sides of that, I'll maybe have $25 worth of credit. And you say, wow, that's awesome. The only problem is if you sell naked, the brokers are going to require a tremendous amount of margin. And then when you calculate out the return on your margin, you actually do better by going with a credit spread, and you're protecting yourself against catastrophic drops. Okay, by selling options, the hyper fast time decay of premiums works in your favor. Especially during the last 30 days, it becomes exponential. And when you're talking about the weekly options, I usually go out about 10 days from expiration, 8 to 10 days from expiration. Okay, and that's when you see this rapid drop. Therefore, it's working for us. That is working for us. Time is working for us. Okay, we are, rather than going into the casino and putting your money on red or black, or putting your money on the pass line, which has statistics that show in the long run it will be a loser. However, you're lured into that because you can get a nice payoff. Well, the same thing's true with traders. They get lured into buying cheap weekly options. Exactly what the market makers want you to do, exactly what the casinos want you to do. What you want to do is sell the weekly options with protection, but do it when the probability is in your favor. Well, when is that in your favor? When it is overbought and oversold. Okay. Why is the SPX the best ETF? All right. Over a third of all the SPX volume is now in the weeklies, creating a fantastic opportunity. Over a third of all SPX volume is in the weeklies. So liquidity is readily available. Liquidity is the key for tight bid-ask spreads. Okay, you're going to get good fills. I always put it in at the midpoint. A lot of times I'll go in at the market because the bid-ask spread is a penny, and I'm not worried about that. Okay. So two things are working for me. One, I'm really cutting down on the slippage because of the liquidity. I get a real tight bid-ask spread. And two, I'm cutting down on commissions because I got a big boy working for me with a lot of credit. All right. Now, the other thing about the SPX is large funds and institutions use the SPX to hedge their portfolios. Therefore, the SPX is priced for a 1% move, but it doesn't move 1% very much. All right, and that's where the regression channel comes into play. Remember I showed you that the plus or minus one standard deviation is about 65%. For the SPX, it's more like 85%. So you got all kinds of things working for you with trading the SPX. All right. So just going back to what we saw here, you know, you've got the regression channel, you've got it oversold at this point in time. You get in there, you get out with the Fibonacci's, and using those two things, you can really zero in on the SPX. Now, Wall Street Jargon is going to make this strategy appear complicated, and it's not. It's not. Especially if you've got a mentor, and I am the best mentor available out there today. My people follow my competition. They want me to raise my prices all the time. They know what's available out there. Okay? The good news is if you don't know anything about options, I can walk you through everything you need to know. You don't have to watch the market all day. I don't watch the market all day. I watch it when it opens for, from 9:30 to probably around 10:30. I watch it at noontime just to kind of touch base with it. And I love to watch the close because that's usually when the institutions and the big boys are either saying, yep, I liked what happened during the day, or they're going against it. And that's from 3 to 4. That's when I watch the market. This is a perfect trading strategy for newer traders with small accounts. We talked about that earlier, but it's not limited to small accounts. The strategies are safe. There's no naked selling. There's no random assignment to stock. You're protected with, we're buying one further out of the, buying an option further out of the money. You're protected. How do I trade the weekly options? 2 steps. 1, place a directional spread when the SPX is overbought and oversold. 2, I exit the trade with a profit on a Fibonacci extension. Or I exit a losing trade when I have a measured move going against me. Simple, 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 simple. Okay. Here's my second example for you. This is a chart. Again, this is a Thinkorswim chart, and you'll notice that my screen, I always have a 90-day 1-hour side, and then a 10-day 15-minute side. This kind of grounds me. Remember, if it's below this regression line, my mind starts turning bullish. And when it goes above this regression line, my mind starts turning bearish. Okay, so this was back here when the market made a double bottom and it hit the -1 on the longer term regression channel. I was thinking bearish. I was thinking, I was thinking bullish. Okay, and along comes a measured move to the upside. Bam, I am in. I am in. And I entered with a 21 July where I sold the 2405 and bought the 2400 bull put, buying the 2400 for protection. Look how far out I was. You know, the market's up around here and I was way down here. And I don't have time today to go into how I determine what that is, but I've got a rule as to where I put in my vertical spread. I got $1 worth of credit, and it went up, and bam, that's where I got out, right there. That's a well overextended Fibonacci. It was approaching the +1 on the regression channel. I got out with only a nickel debit. So that's a 95% return in 1, 2, 3, 4, 5, 6 days. 6 days. Okay. I could have gotten out right down here with a profit. I could have gotten out right down here. I chose to stay in that one because it looked pretty strong. It came up, gap open, and it looked very strong. Had a little bit of a pullback, which is okay. Okay, because this is a higher low, so the trend is still up. And just when it got to the 261, you know, I've seen many times on these Fibonacci's. It's almost uncanny. I mean, look at this one. I've seen it come up to like a tick. And what causes that? Well, Fibonacci's are based on mathematics. You can see Fibonacci ratios throughout nature. Just a quick example: if you take the distance from your forearm, from your elbow to your wrist, and divide it into the distance from your wrist to your fingers, you will get a Fibonacci number. It's called the golden ratio. And Rolf says, who supplies these Fibonacci sequences? Well, they're automatically done on Thinkorswim. And if you want to know more about it, Rolf, all you have to do is become a free member and go in there and listen to a webinar I produced on how I use the Fibonacci extensions. Okay. Let's see. So yes, so I use the 15-minute to trigger not only the exit chip, but the entry too. Okay. This is my grounding chart, if you will. Okay. And then my trading chart is this guy over here. And when this is oversold and this is oversold and I get a measured move, bam, I'm in. And when I get a Fibonacci extension, bam, I'm out. When I get a measured move going in the opposite direction, bam, I'm out with a loss. That's that easy. It's that easy. Okay. This is kind of an eye chart, and I'm sorry, but I wanted to show you that I started making this public July 13th, 2016. I've been trading this for years. I've been teaching this to my mentees for years. I went public with this on July 13th of 2016 last year. And the interesting part about that is my total return in the first year was 652%. 652%. Not bad. This is the last 21 month results based on $1,000 per trade, and this is a 25x return in 21 months. 25x return in 25 months. Look at the down draws. This is the kind of equity curve you can go to the bank on. This is the kind of strategy that you want to learn. You want to learn it. You want to play with it. And you want to stick with it. Okay. Some of the members, I just brought some of these up because I think it's important. I paper traded and did well. That's the key. I learned it from Dale. I paper traded it. I did well. And then I started to trade with real money. Perfect. I've been making money on the SPX. I started with 1 contract. Now I'm up to 10. Perfect. When following your rules, I'm 5 for 5. Okay, averaging 74% per trade. I really enjoy trading the SPX. I started out paper trading. For 3 months, he paper traded. And then he started live. The results have been fantastic. I've done 8 live trades with 4 to 10 contracts. The average gains of $1.15 per contract with 100% winners. Well, that's not going to always happen. And that's why I want you to paper trade. I want you to see what you do when you get losers. Okay, Rosa. On Thinkorswim, it's not called the regression channel. You go into Thinkorswim, you go onto, hold on for a second. You go into under edit studies, and you look under standard deviation channels, standard deviation. All right. Also on my website, I tell you exactly how to do that. I show you exactly what to do. Step by step, I take you through how to do that on Thinkorswim. So you might want to do that. Okay. And yeah, you can set up regression channels for any time length you want. It's all based on you know, the length of time. That's how it's calculated. All right, let me go into my website now. Let me bring it up first. And I want you to become free members. That's the first thing I want you to do. So let's go into Options Infinity. And the first thing you can do is become a free member. Okay, once you're a free member, you're going to have access to all the webinars that I've produced talking about how I trade, why I trade, regression channels, measured moves, Fibonacci's, psychology of trading. And then here's my 2 programs. I've been talking to you today about the SPX War. War is for weekly option regression. If you become a member of that, you get a 4-part video course where I show you exactly what I do. You can see the open and closed position list. I send out real-time text and email alerts. Now, I'm not a registered investment advisor or a licensed broker. Therefore, when you get a real-time text alert from me, it basically is saying, I am doing this with an approximate price of this. You then have to take that alert, look at your chart and say, this makes sense for me, I'm getting in. Bill said, do you use the RSI? I do not. There are a myriad of indicators out there. I use 2, regression channel and Fibonacci's. I have a daily session review, it comes out every night. Once a month, we have a live session with me, not one of my employees, me. Okay, and every session and every monthly session is recorded and archived. All right, this is based on the weeklies on the SPX. You want it a little bit slower, you want it based on the big 5, the options on Amazon, Priceline, Google, RUT, and the SPX. Options Pro is for you. It's a little bit slower. Same thing. 4-part comprehensive video, position list, real-time text and email alerts, daily session reviews. I mean, I'm here. You get my email address. I'm here to help you. I want you to become a success. And then you want to. I just recently put an article was published in Trader World. You might want to take a peek at that. Here's some examples. Here's some examples of what I do on a nightly basis, both for the 2 programs, SPX and Options Pro. You know, and then here's some of the testimonials down here. But I'd love for you to become a free member. We're also I'm currently working on right now putting on a frequent basis just a nightly educational tidbit. I'm going to talk about books that I recommend. I'm going to talk about Fibonacci's. I'm going to talk about what some of the successful traders, how they do it. I'm going to talk about all kinds of stuff, and that's going to be free to members also. And then if you want to become a member, if you like what I am, what I stand for, how I teach, what I do, you can become a member of the two programs. One is a little bit longer term, one is the short term, and you can learn more about those on my website. And I really enjoyed talking with you today.